Steve, great to have you here. Let's start off on the quarter that just was. I mean, no surprise here. We kind of know how many vehicles they're producing, how many vehicles they're selling. But we're now on this precipice where here in the U.S., that $7,500 tax credit that you got is no more. And I do wonder how that changes the value proposition for Tesla and whether that means that their goals, their short-term targets, can actually be met.
Well, that's the big question. I think the results are kind of a tale of two cities. What you're seeing here is record Q3 results, but what that really is an indicator that a lot of people are racing to get that tax credit that President Trump has taken away. So China growth looked pretty strong. U.S. growth, we saw the bubble, but we expected that. The worrying part was European growth. That was down 20%, but it's down 20% at precisely the same time EV sales in Europe were up 30%. So there appears to be some brand damage there, competition coming. Tesla's going to have to manage this. They've got to find a way to get growth back, profitability back up, operating margins down 40%. That's never a good sign. I think Q4 could be tough for them. They've got to find ways to get that revenue back up.
I am curious about sort of the methods that they would have. And maybe you can just kind of put in your hat from the old days. I know it was a long time ago when you were on the board. But there's this idea that you have a company that doesn't advertise in the traditional way and doesn't even necessarily market itself, I mean outside of advertising, in a way that you would see other car companies or really other consumer product companies overall. Could that maybe be a switch they can flip, or are they just so reticent to do that that it's just not going to happen?
Well, it's going to be tough to flip that switch because you got two things going on. There's Tesla, the auto company, and then there's Tesla, the technology company. And let's get down to the numbers. They did $28 billion in revenue this quarter. That's fantastic. But the last two quarters were 23 and 24 billion. They got to do 30 billion in Q4 to get back up to 100 billion. I think there's a good chance they end up at Q4 at a number closer to 25, 26 billion. That would mean this would be the first year in their history where they had declining margins. Now, when your PE ratio is 250 compared to NVIDIA, which is not exactly chopped liver at 50, you've got to wonder, will they be able to keep that up? Now, what do they do to fix this? One, come out with a lower cost car, not a $37,000 car. I think they need to announce they're going to bring a $25,000 to $30,000 car to market. Two, saving grace in the numbers this quarter, their energy division is taking off. They're selling more gigapacks in their new giga blocks than ever before. That grew 25% year over year. I think they're going to do 14 billion in energy products alone. So that's looking like the saving grace now. But I think within about a year, if they haven't really knocked it out of the park with their full self-driving or begun to bring humanoid Optimus robots to market in scale, they're going to have some explaining to do. You might see some grumpy investors.